been an options trading bonanza now for months as equity markets have rallied off the lows, and everyone from pros to first-timers have been in the market. Let's bring in Henry Schwartz for an update on volumes and more. He's head of product intelligence at CBOE Global Markets. So Henry, it's no secret that at this point the market has been to some extent supported by a lot of options trading and call buying. What's the status of that situation right now?
Well, you're right on. Last year was out of the park as far as options trading has ever been. We saw 7.5 billion contracts trade. It's up about 55% from the year before. New all-time records. I did a presentation last week, and the 10 busiest trading days basically happened in the last 6 months or so, including just Friday. We traded over 50 million contracts in a day. So, volume is just it's just off the charts, and it's sustained. One of the most interesting things that we've been watching is the amount of call trading in single stocks, which it just kind of keeps on coming. And there's a lot of discussion about why and how, and but it is the first few calls I got last year about hey, do you think this call volume is really kind of starting to be the tail that wags the dog? And the first few times I was like, no, call trading retail, it kind of it comes in little bursts here and there, but it doesn't really have enough power to move things around. I've become a believer that the call buying that we're seeing, particularly out of the retail world, is really driving a lot of the action that we're seeing.
Now, Henry, is that just because of the sustainability of it? Is it that we can draw lines between the single contract volumes and the types of companies that those traders are more prone to trade with those single contracts? I mean, the contract size decreased substantially. You've got in your presentation, as you mentioned, some of the data. Every single metric of volumes and daily volumes and trade quantities, everything's up except for the trade size last year on a year-over-year basis to the point of these single contracts. But what's that connective tissue that can lead us to attribute some causality?
I think, what you're seeing is, obviously, since we bottomed out last spring, the trade that was incredibly successful was owning calls, right? The bounce back was stronger than expected. There's an incredible amount of reshuffling and revaluation of what companies are going to do okay in this new era that we're all living through. Seeing using one lot trades as kind of a proxy for retail is the closest that I think you can come to specifically saying, okay, we see retail call or put buyers in Tesla or NEO or GameStop, and you see where this kind of crowd of retail is putting their money. I mean, there's the one of the adages is don't fight the Fed, and that's absolutely still true, and it applies to our current situation. But don't fight the retail flow is another one that makes a big difference this year, because what you see are is an enormous amount of capital flowing into these names that get hot, and I think in some cases it's very speculative, and in other cases it's people putting their money where they believe the rebounds are going to be, where they believe the opportunity is.
What will you be looking for, Henry, to see when this trend shifts? I mean, the one measure would be just to look at the number of those single option contracts to see when that momentum slows. Might it show up in different types of trades first, though? I mean, if we look at average daily volume in ETFs versus indexes versus single stock calls, pretty much everything looks fairly unremarkable except those single stock calls. So just kind of looking at the same way here, but I wonder what this chart might look like if the trend starts to change. Would we expect those single stock calls in the dash line to turn lower? We saw that in some brief moments of volatility. If we look at the kind of plateau in the fall, that was when the market got a little choppy, the NASDAQ, but during that time, you didn't see puts pick up. The orange line are ETF puts, the yellow line are index puts. So what are we watching here to see if this trend actually changes?
Well, I am going to be watching the single stock call volume very closely, and specifically what sectors are seeing the focus. You're right. When the market kind of stops going up for several days in a row, basically these call buyers stop making money, and then they have to kind of change up. Either they just step back from the market, and so you see the volume kind of plateau, or you see, I think what you're going to see is, there may be a couple million new option traders that entered the market last year. I mean, this is what the data shows. I think that a decent portion of those, have had 6, 7, 8 months to kind of learn more than just, okay, I buy calls and the stock goes up and I make my money, but to kind of expand their expertise and their trading style into spreads and into put buying. It's been a pretty horrible trade for most of the last 9 months or so. But if the market starts to kind of falter, we've had an incredible run. Some of these names, not only do we have new highs in Johnny John and GM and Tesla and everything else, but if the market starts to pull back, I think first you'll see the people step back and try to figure out what's going on and what can they do that might make the money, and then you might see a shift into basically vertical spreads, call spreads, even kind of time spreads for the more experienced traders.
Henry, so the idea here is nobody wants to go in a direction that hasn't been profitable, right? Just momentum has been so powerful. Getting in the way of it has been a bad move, to say the least. In terms of volatility overall, walk me through right now the way you're viewing the VIX and the way you're viewing the impact that this is having. Even though it's a bullish type of speculation, is this degree of speculation putting support into the VIX as a measurement of volatility? Oftentimes people think about VIX as being inverse to stocks. That's not always true, right? About 20% of the time or so, you'll have stocks move up and VIX move up, or VIX move down and stocks move down. But generally speaking, 23 is higher than what we've gotten used to over this bull market cycle. Is that because there is real concern built into the market still, or is it just because all the speculation in the options is still putting support into a VIX, even if it's bullish speculation?
Well, it's a good point. For decades, it's been kind of like, okay, when the market crashes, VIX goes up, and then it starts to settle back down. And as the market goes back up, VIX, usually market goes up and volatility, implied vol, goes down because people are just more comfortable. That's not what we've seen lately. And in a lot of these single names, we're getting bigger moves in volatility to the upside when the stocks go up than to the downside. So it is a different kind of regime that we're in, for sure. VIX, most people were like, oh, well, it'll be under 20 in no time. In fact, at the end of last year, we saw some big trades right ahead of the election that were downside spreads in VIX, right? We saw like the 14-20 put spread. People basically buying those 20 puts, looking for the level of VIX or the VIX futures to drop below 20, and that has not happened. One thing that's going on is you have a lot less volatility sellers in the market, really because of how the last year went, right? Anybody that was kind of systematically selling volatility got hurt badly in the spring. So that fundamentally takes a lot of the sellers out, and then you end up with kind of a higher level of VIX, even if that's not justified by the realized volatility in the market. So we're seeing a little bit of that. And I think that the kind of geopolitical things and COVID continuing, you just still have a lot of people that are nervous about the market. That shows up in the SPX option prices. It shows up in the VIX futures. And I think we're going to hang out here for a while. It may be an opportunity for some volatility selling by with strategies that are kind of capped, and by traders that are comfortable with that idea.
Okay. Henry, I like the details and I like the thoughts here on the driving forces behind volatility, both to the upside and within the VIX itself. Appreciate you coming back to us here, Henry.
Thanks, Oliver.
Thanks a lot. Henry Schwartz is the head of product intelligence at CBOE Global Markets. Interesting stuff.